We talked about the 45.20 level and the 45 handle. Well, we've taken out the 45.20 at the open, didn't we? The 45.20s became sell-side SPX. Remember, we're talking about the SPX here. And obviously that sell-side SPX is just driven down to 44.94. And we gave you the 45.20 on the SPX at the top edge, didn't we? Now, why would the 45.20s be important to us? Because obviously it's a wholesale price level. It's the wholesale price level that's in play. So when we go all the way back into the cash close and we look at the cash close up here, for example, we can see that going into the cash close, the 45.20 is going to get a lot of business because it's at the money. It's pretty much at the money price at that stage. So obviously the 45.20s at the close of yesterday is pretty close to at the monies. That's going to put a lot of volume in there. And because it puts a lot of volume in there, as we trade into the cash open today, there might be a lot of put options at 45.20. There might be a lot of put options at the money at 45.20. So we look at the at the money strikes and we obviously start thinking to ourselves, right, there's been an increase in the price of volatility. There's been an increase in demand for volatility. So the only way that's likely to happen is if people have bought a lot of put options. Where do you buy a lot of put options? At the money. We know that most of the volume in the options market is at the money options. And if we know that it's at the money options, where's at the money options? 45.20, 45 evens would be a reasonable area to think about those at the money puts. And therefore my concern is that the 45.20 is going to have a lot of trade up here. And if it rejects, it's going to put a seller into the markets. And look at what happened on the rejection. The seller came into the markets and we got this very aggressive sell away from that. And when we've cleared the 45 handle, look at what just happened. As we cleared the 45 handle, the market started to aggressively sell away from that 45 as well. Did we predict this before it happened? We didn't predict it was going to happen because it's got to do the elements first, hasn't it? We're not predicting that it's going to happen. We are suggesting that if the price rejects off of these, that this is what could happen or what probably will happen. But the price might have went through 45.20s and never looked back at 45.20, in which case all those at the money puts never got hedged at 45.20s. Never got hedged at 45.20s. So because it never got hedged at 45.20s, it never became slippy at 45.20s. So when we see that it never became slippy at 45.20s, there is no trade, and everybody goes, you were wrong. No, we weren't wrong at all. It's about an event that would be having to take place for it to become slippy, and that event is a rejection of 45.20. So as the price rejects 45.20 at the top edge, it becomes slippy. And if it rejects 45 evens, it becomes slippy. And we can see that that slippiness has resulted in this sell-off and then this sell-off. Two simple, easy to understand concepts added into the mix based on yesterday's pricing of volatility, suggesting that there was a lot of put options getting taken into the close. And we already told you that, didn't we? We already highlighted that that's what we think is probably happening. It's already there from 11:50 last night, which is now 15 hours ago. Concerns about volatility increase on the close, suggesting that we've seen some buying of puts on the uptick. And with Warren not bullish, I would be concerned about tonight about any slippiness off that 45.20 level, and then obviously a break of 45. It's got to go back through the 45.20s. It goes up to the 45s and then it sells back out the 45s. That's the slippiness that we've just seen. Called in advance, executed on the right-hand edge, guys.